You're just in time for Martin Crabb, CIO at Shaw & Partners. Martin, welcome.
Thanks, Nadine.
Good to see you.
Good to see you too.
Metcash is, I think, the worst performer on the 200 if everything continues on. That's despite increasing its payout ratio, hardware sales going up for the beginning of this second half, supermarket sales still going up in the first 4 months of the second half. What more does the market want?
Don't forget booze. Booze sales are up as well. So, you look through the company issued a trading update today and went through quite a long slide deck in terms of their strategic outlook. They had each of their group heads talk about their plans for CapEx and how they're going to eke out cost savings and that sort of stuff. And it all read reasonably well. It was obviously just shy of where the market was expecting them to be. So, the longer term story on Metcash is that it's going to lose between Coles, Woolies and Aldi. It's in the weaker competitive position. But the company has done a very good job at running the IGA stores better. They're refurbishing them, and they've also expanded the footprint into hardware and tools and trade and that sort of stuff. So they're actually pretty well positioned for the reopening. But I just think the market got a little bit ahead of itself. But I didn't spend the whole day listening to the things, but I had a look through the slide deck. There's a reasonably good story out there in terms of how they're going to spend capital, but also maintain discipline and, as you said, boost the payout ratio. So it's not often you see a company spend a day talking about how much money they're going to spend, but by the way, we're going to increase the dividend as well. So that was a good news story. So the stock doesn't look too bad. I just think it had probably run ahead of itself, and the market was just a little bit disappointed that they weren't more forthcoming with positive guidance.
And it comes on a day that I will note Coles and Woolworths made some decent gains, up by 1.5%, 1.6% respectively.
Yeah.
So is Metcash in buy territory for you, or would you still favour the others?
We're probably boring and stick to either Coles or Woolies, and whoever's operationally performing the best the market seems to love. So that was Coles for a while, and that's now Woolies. So Woolies is the stock everyone wants to own in that space. Coles is kind of like they've lost all of that momentum that they had last year, and obviously Woolies is reclosing the gap, or reopening the gap, I should say.
Martin, even forgiving that we saw a bit of a pullback in yields today, we've seen that longer dated yields here in Australia and around the world have gone and picked up a little bit of late. Generally that hits the REIT sector harder than most, but one thing I've noticed recently is that the REIT sector has managed to go and brush it aside the last couple of days. What's cracking there?
Well, I think that probably the bond market's got ahead of itself a little bit. We have seen a little bit of a pullback in long-term yields from their peaks because it kind of went nuts there for a while. The REIT sector's underperformed the index by about 8% so far this year, so it's been a victim of the higher bond yields. But Broker Note today just pointed out that, look, the sector's probably reasonably good value. It's trading at a discount to NTA. I mean, NTA is a little bit of a sort of made-up number because who really knows until you actually have to sell. But the sector globally is probably trading at a premium to NTA because everyone thinks markets are recovering. So there's some reasonable valuations there, but the stocks you want to own, and they performed really well today, are the growth REITs, which is Charter Hall and Goodman Group. So Goodman Group's obviously a play on e-commerce because it's sheds and logistics and so forth. And Charter Hall's obviously more of a developer in more a diversified player. But they've both got pretty good property footprints and pretty good growth stories. So a little bit of a rotation back to long duration assets today, hence all the tech and healthcare stocks doing quite well. So that, on the back of that broker upgrade, I think saw some pretty good moves in those stocks today.
Goodman and Charter Hall, both fan favourites there at Shaw's?
Yeah, Charter Hall's not one we're that close to, but we certainly own Goodman's. I mean, most real estate investors have a pretty good weighting to Goodman's because it's a play on e-commerce as well as just being a REIT that's going to give you income. They have a significant development pipeline. They've got lots of dry powder and they look like they're going to grow at 10% for years to come.
Yet they have been a pandemic performer, if you can call it that.
Absolutely.
Now, we are mildly obsessed right now with what's going to come from the FOMC, for good reason, because we've heard so much from central banks, so much about the reflation trade, inflation, and how they are likely to remain on hold until 2024, at least in case of RBA. But the economic data that we're getting seems to be telling perhaps a little bit of a different story. That's in the US and here. Yeah,
I think so. I think the supply bottlenecks are definitely re-emerging. And also the concern about what pulling some of these vaccines out of the market's going to do to the recovery trade. So they're sort of two sides of the same coin. The shortage of things like shipping is really important. So it's a thing called the Baltic Dry Index, and it's a measure of the price that it costs to move containers around the world, and it's shot up to a previous high. So the last time it shot up this high, there was a period of slower growth because you just can't get goods to market. So that index is telling us that, and the slowdown in credit in China is telling us we're in for a couple of months of maybe sideways economic performance. So that should make the bond market chill out a bit, and might see that rotation that we saw today just continue for a bit longer. So what that means is that the bond market's not going to continue to sell off. It'll probably rally, i.e. yields will come down, and people will start looking at, right, where's the growth in the economy? It's in healthcare, it's in technology. So when I was on here last week, I said that those sectors typically perform quite well when bond yields are rising, because that's where all the growth is. So I think what you saw today with Zipco and EML payments and these sorts of stocks, there's going to be a rotation. Because remember, these things have come back a long way. The tech sector in Australia has fallen, 15, 20% from its highs. So I think that we'll see that money roll back in. But where does that leave the FOMC and other central banks? They're just going to stay the biggest cheerleaders about the economy, but the fact that we've got more work to do to get back to where we were and where we want to be.
We want to see some really exciting freight rates. Look at Shanghai to I think it's Amsterdam in the containerized freight rates. It's off like a firecracker. It just soared. So that's a good sign when it comes to demand for goods out there. You touched upon some of the weakness that we're starting to go and see, and it's only mild weakness in China. Everyone seemed to be bullish about the commodity super cycle a month ago. Then all of a sudden it seems to have fallen apart in the space of a week. Where do you sit when it comes to the big miners at the moment? Obviously they're still churning out big profits, but how long will it last?
Look, everyone I speak to, buy side, sell side, economists, strategists, all say iron ore doesn't stay here, it goes lower. And that's just a supply demand. As Brazil comes back online, and then as Simandou in Guinea gets developed, there's going to be 400 more million tonnes of iron ore in the world, and that's going to put the market into deficit. Now, the timing on that's always tricky because Brazil, has got problems now. They had problems in the past, and Simandou, who knows when that comes on stream. But definitely that market is one that you want to be fading. We've talked about fading the rally. Now, we faded iron ore in our portfolios way too early. It just kept going, but we're starting to see the cracks a little bit in that market. China's an interesting one because the lever that they're pulling is pollution, right? So obviously burning coal to make steel is highly pollutant. And so at certain times of the year, the Chinese government says enough. The air's too dirty.
Have you seen any of those pictures? I mean, it's
pretty
horrendous.
Yeah, I mean, I was in Beijing a few years ago, and you could see your hand in front of your face. It was terrible. And there's so many trucks coming in. So the trucks come in after dark. And just fill the place up with pollution. So it's pretty bad. So at certain times during the year, the Chinese will say, like, let's shut the steel mills, and then all of a sudden the iron ore market falls away. So I think, it's a trade to be on the short side of. It's just a question of timing, in my view.
Well, Goldman Sachs is tipping a 30% drop in the price of iron ore, and that's by year's end. So that's a pretty significant fall, but from pretty elevated levels.
They still upgraded, right?
They did. BHP,
so they said
Rio,
it's going to fall, but it's not going to fall as much as we thought it was. So they ended up upgrading Rio and BHP. We call them begrudging upgrades.
It didn't help BHP today. It was down by about 2%. But again, that's speaking to a little bit of that rotation that you were talking about. But I mean, you're talking about Baltic dry indexes. I mean, you've only got to think that the Biden stimulus is going to exacerbate those issues as well. We were chatting with Joe Biden, and he's now on the director on the board of Rode Microphones. And I mean, even they are expecting a big surge in demand coming from that stimulus. And it's not even really a direct-to-consumer product. In the way that we think of consumer products.
So it's a big number. It's 10% of GDP in the world's largest economy. So it's going to have an impact. And even if some of the programs are more longer term duration, infrastructure sort of stuff, it's a massive amount of demand. So, we're throwing that, petrol on the fire. But the market's priced in $1.9 trillion stimulus. It hasn't priced in bottlenecks, and it hasn't priced in a slowdown in China, and it hasn't priced in more of these vaccines being taken off the market. So you just kind of feel there's a little bit of tapping the brakes by the market and a bit of rotation back from value into growth. Value, MSCI Australia value has outperformed MSCI Australia growth by 40% in the past 12 months. It's been a massive reversal, so maybe that just comes off a little bit.
And a lot of that reflects that we've got such a big weight into the banks here in Australia. Of course, they've really outperformed the broader index. I was reading somewhere today that typically in a cycle, when banks outperform, it lasts for years rather than for months and quarters. Is that your take, where it is in the infancy of an outperformance period, or have we run so hard already?
It's a really tricky one. So I think banks probably are being disrupted they're probably industries you don't want to own a lot of in your portfolio, just because they're just having their world eaten for them by payment systems and Afterpay and all these other fintech companies. So I think they're in long-term structural decline, but they're in a cyclical upswing. So I think you want to own them for the cyclical upswing. Housing prices are going nuts, credit growth's going nuts, bad and doubtful debts are zero, margins are holding up, Reserve Bank's giving you money for free. You want to own banks in that cyclical uptrend. But I think there's a point you go, well, okay, I still think longer term these businesses are in decline. I want to own tech, I want to own healthcare.
Yeah.
Since November, since the vaccine was announced, ANZ is up 45%.
Yeah.
I mean, that's a massive gain. That being said, the local market has done not a lot lately. 68, 32. So the catalyst for another leg up for the Australian market, in your view, is what? Because plenty of conversations we've had, people expecting relative outperformance from the Australian market this year.
Yeah, we've had two very powerful opposing forces at work, and they've been in equilibrium. So we've had very strong earnings growth and very strong dividend growth expectations all through reporting season. So earnings have been revised up 5 to 6%, and dividends probably double that. So that hasn't been reflected in share prices because we've had PEs come down from 20 to 18 times, and that's on the back of higher bond yields. So if I'm right and there's a little bit of a slowdown in growth, enough to get the bond market to chill out and realise that central banks are going to keep rates at zero for 3 or 4 years, we'll see a retreat in that bond yield, and that'll push PEs back up to 20. That's 10% upside just there, right? So that's kind of how I'm seeing things. You want to be long the market because that's the environment we're in, that the earnings growth is going to outweigh the rise in bond yields. Not all the time, like February was the opposite of that, but I just think that's kind of how I'm feeling it. We're still seeing analysts upgrade earnings, even though reporting season's come and gone. I still think there's positive momentum. And things, as you said, Nadine, like the spending packages, once they actually hit the market, companies will upgrade their earnings expectations on the back of it.
Granted, the Aussie dollar is a little bit weaker than what it was a month or so ago, but I was looking at the XJO priced in US dollar terms, and it's broken high. When it comes to conversations and the headwinds created by the higher Aussie dollar, is that still resonating in some of the conversations that you're hearing about?
Yeah, I still think the market view is that the dollar goes higher, the Aussie goes higher against the US, just because of the amount of money that they're printing. It's just a supply of fiat currency, really. So it then becomes a conversation about, if you do own global equities, you should hedge them. But in your Aussie portfolio, there are companies that earn US dollars but do well when global growth's rising. So your cyclicals, materials, etc., energy. So you really don't worry too much about the currency with them. Even the building materials stocks, you don't worry because the economic growth's strong enough to offset. The issue is the defensives that earn in US dollars. So your Brambles, CSLs, these sorts of stocks. So we've been taking them out of portfolios because there's not enough growth headwind to offset to offset the currency. So that's kind of how we think about it in portfolios.
Well, it's always worth asking that last question, isn't it? Because we always get more. Martin Crabb, CIO, Shaw & Partners, thank you so much for joining us.
You're
really
welcome.
appreciate it. Now,